Hello everyone, welcome back to Boss Economic World. I'm your host. Today is November 29th, 2025. Grab your pretzels and hold on to your lederhosen, because we are about to dive into the most unexpected plot twist of the global financial decade. If I told you 3 years ago that the hottest, most raucous party in the global equity markets would be happening in Frankfurt, yes, the city where fun usually fills out a triplicate form before entering, you would have laughed me out of the room. You would have said, boss, Germany is the sick man of Europe. They love austerity like a grandmother loves force-feeding you soup. They will never spend money. Well, folks, the sick man has apparently chugged a Red Bull, hit the gym, and is now bench-pressing the entire European economy. Today, we are going to analyze the truth behind the German Wirtschaftswunder 2.0. We are going to look at how a massive €500 billion spending bazooka has turned the DAX into a rocket ship, why Chinese and American sharks are circling German waters, and why, paradoxically, the only people who don't seem to realize Germany is booming are the Germans themselves. Let's peel back the onion. To understand why the Deutsche Börse AG's Capital Markets Conference this week felt less like a boring symposium and more like a rock concert, we have to look at the macro picture. For decades, Germany worshipped at the altar of the Schwarz Null, the balanced budget. It was a moral imperative. Debt was a sin. But as we discussed back in 2024, you cannot run a 21st century digital economy on 20th century infrastructure and 19th century bureaucracy. The bridges were crumbling, the trains were late, and the internet speed was comparable to a carrier pigeon with a limp. Fast forward to late 2025. The pivot we are seeing is historic. The German government has effectively said, auf Wiedersehen to austerity. The headline number is €500 billion. That is the size of the new infrastructure and transformation package. Now, usually, when governments announce big numbers, I tell you to be skeptical. I tell you it's accounting magic. But this time, the market is buying it. Why? Because the money is actually moving. This week, at the Deutsche Börse conference, we saw a record 2,100 participants. We aren't just talking about local guys in gray suits. We are talking about family offices from Singapore, hedge funds from Connecticut, and private equity giants from London. They smell blood, and they smell money. The German stock market has rallied 20% this year, completely leaving Wall Street in the dust. While the S&P 500 has been wheezing, trying to figure out if AI can actually make a profit, the DAX and, more importantly, the mid-cap MDX, have been tearing upward. Why? Because the German government is finally doing what every Keynesian economist has been screaming about for 10 years, fiscal stimulus. Let's look at the mechanics. This €500 billion isn't just being thrown out of a helicopter. It is targeted. And in economics, where you spend is just as important as how much you spend. The package implies massive outlays for two specific things, defense and infrastructure. First, infrastructure. Germany is essentially rebuilding itself. We are talking about the energy grid transition, finally fixing the Deutsche Bahn, and digital infrastructure. This brings us to the companies. If you are a construction firm, a cement maker, or an IT service provider helping the government figure out how to use the cloud, you are printing money right now. Take Cancom SA, for example. They are an IT services firm. At the conference this week, their vice president, Lars Dannenberg, basically said they had to turn people away. He said, we were unable to hold talks with all the investors wanting to meet. Think about that. In the financial world, an investor relations officer turning away meetings is like a bartender saying, sorry, we have too much money, we can't serve you. It doesn't happen unless you are the hottest girl at the prom. Cancom is benefiting because Germany is frantically trying to digitize. The government has realized that fax machines are not secure against cyber warfare. The billions flowing into digital sovereignty are landing directly in the pockets of firms like Cancom and Nagaro, another IT heavyweight, reported getting frequent takeover interest. Now, let's talk about the darker, but incredibly profitable, side of this boom, defense. We all know the geopolitical situation in 2025 hasn't exactly been a yoga retreat. It's tense. Germany's Zeitenwende regarding its military was announced years ago, but only now is the money actually hitting the factory floors. This isn't just about the big guys like Rheinmetall. The smart money, the boss economic money, looks at the supply chain. Enter AlzChem Group AG. They are a chemicals producer based in Bavaria. Sounds boring, right? Wrong. They produce nitroguanidine. For those of you who skipped chemistry class to trade crypto, nitroguanidine is a propellant. It's what you put in ammunition to make it go boom efficiently. Andreas Niedermeyer, the CEO of AlzChem, told Bloomberg News something fascinating. He said only about a quarter of his meetings at the conference were with German investors. The rest? French, British, and American firms. Why is this important? Because it shows that international capital understands the German value proposition better than domestic capital. Foreigners see a country rearming, rebuilding, and reindustrializing. They see AlzChem and think, every shell NATO fires needs this stuff. The valuation gap is real. German defense suppliers trade at a discount compared to their US peers like Lockheed or General Dynamics. That gap is closing fast, and that creates the 20% rally we are seeing. This brings us to the most exciting part of today's analysis: mergers and acquisitions. If you are a fan of shopping for luxury goods at discount prices, welcome to the German midcap market. The SDAX and MDAX indices are filled with what we call the hidden champions. These are world-leading companies in niche markets, industrial adhesives, specialized ball bearings, robotic arms, that nobody talks about at dinner parties. Despite the rally, these companies are still trading at historically low valuations compared to their earnings potential. Why? Because for the last 3 years, sentiment on Germany was terrible. The stock prices were depressed. Now, combine low stock prices with massive government stimulus. What do you get? You get a for sale sign on the entire country. Lucas Ponsgen, the co-head of M&A at Bank of America, put it bluntly: the underperformance of stocks from smaller companies will lead to continued take-private activity. Take-private is banker code for, we are going to buy this company, delist it, fix it up, and sell it for double. Apollo Global Management, one of the biggest sharks in the private equity ocean, has announced plans to deploy up to $100 billion for financing in Germany. $100 billion. They aren't bringing that kind of firepower to buy bratwurst stands. They are coming to buy industrial assets. Let's look at a specific rumor that broke this week: Puma SA. Puma is a German icon. But it's been struggling a bit against Nike and the rising casual trends. Who is sniffing around? Anta Sports Products Limited from China. This is a classic play. A Chinese giant with massive cash reserves looking to buy a heritage European brand to expand its global footprint. If Anta buys Puma, it's a signal that German assets are viewed as prime targets for global expansion. It's not just China. It's American private equity. It's French conglomerates. It is a feeding frenzy. And for you, the retail investor, this is where the opportunity lies. When a takeover happens, the stock price usually jumps 20% to 40% overnight. The market is trying to guess who gets bought next. Now, here is the twist. The irony that makes this story perfect for Boss Economic World. Armin von Falkenhayn, Bank of America's outgoing head for the region, dropped a truth bomb at the conference. He said, foreign investors have a much more positive view on Germany than its citizens. This is the German paradox. If you talk to a German taxi driver or a shopkeeper today, they will tell you the country is going to the dogs. They complain about the bureaucracy, the trains, the taxes, and the weather. There is a cultural pessimism of Weltschmerz that pervades the domestic mood. But if you talk to a fund manager in New York or London, they are drooling. They see 1. A stable political environment. 2. A government finally spending 500 billion euros. 3. World-class engineering companies trading at 8x or 10x earnings. This divergence in sentiment is your edge. Markets move on the delta between expectation and reality. The locals expect failure, so they don't buy. The foreigners see value, so they pour in billions. Eventually, the locals will wake up, see the DAX at record highs, and panic buy at the top. That is the cycle of life in financial markets. Bank of America's fund manager survey in November showed that Germany is now the most preferred European equity market. That is a massive shift from just 12 months ago when it was the least preferred. Of course, we are economists, not cheerleaders. We have to look at the risks. Is this a sugar high? The 500 billion euro package is great, but execution is everything. Germany is famous for planning projects that take 10 years to start. However, the pressure is different this time. The external threats and internal economic pressure have forced the bureaucracy to speed up. Bank of America expects the real economic boost, the GDP multiplier effect, to materialize in the second half of 2026. This is crucial for your timing. We are currently in the anticipation phase. The stock market is rising because investors expect the growth. The actual economic data, the GDP prints, the quarterly earnings, will start to explode upward in late 2026. This means we are early. The rally has legs. So, how do we restore the full picture? Germany has essentially performed a leveraged buyout of its own economy. It has leveraged its clean balance sheet to borrow 500 billion euros to modernize its industrial base. This has created a three-layer opportunity. 1. The large caps, the beneficiaries of the infrastructure spend. 2. The takeover targets, the undervalued SDAX/MDAX companies that are being hunted by private equity. 3. The banks, somebody has to finance all this deal-making. Deutsche Bank and Commerzbank are earning fees on every one of these mergers. The conclusion is simple: the narrative has shifted. Germany is no longer the prudent housewife saving pennies in a jar. Germany is now the construction foreman buying new equipment on credit because he has a massive contract to fulfill. The locals are too grumpy to see it. The Americans are too greedy to miss it. If you are looking for a market that offers growth without the insane valuations of the US tech sector, look across the Atlantic. The old world is learning new tricks. As always, this is not financial advice, I'm just a guy on the internet analyzing the madness, but if I were Apollo Global Management, I'd be buying too. I'm your host, and this has been Boss Economic World. Don't forget to like, subscribe, and leave a comment below. Do you think the German boom is real, or will it get stuck in paperwork? See you in the next episode.